good morning, guys. This is Julie J. Auto Trading Strategies, and I'm going to show you something very useful. I think that you'll find useful today. So sit back and enjoy this. You know, our you get an assumption, a set of assumptions, and you go with those assumptions until you're proven wrong. Right now, I'm going on the assumption that the markets are generally adhering to a 14 period, a standard 14 period default. So that applies to your stochastics, to your RSI, to your CCI, to your Donchian channels, to your ATR. Just about everything is on a 14 period, your SMA. So, given those assumptions, let's put it to the test. I've got a chart on the screen of 405 minutes, which represents the RTH session, 300 days. Then I've added two more charts to the screen below it, one a daily, just normal daily, 3,000 days, and one a weekly, 5,000 days. They're on the bottom of the monitor. You can't see it. I've got them scrunched down. So what I want to do first is apply some Donchian channels to the chart so that we can see that 14 period range that I'm, relying on for my assumptions. And so here is the RTH settings, and I want to apply this to the first monitor and make sure my input is on 405 minutes. That's good. Then I want to add a second one. I'll load. I've already saved this one for the daily, for green, to match the PT indicator. And I want to just change the input to daily. And I want to put this on the first screen. And then my third Donchian channel, I'm going to use blue. I've already preloaded one up for weekly for blue. And I just want to change the input screen to the weekly. And I want to put it in panel 1. So now I've got three Donchian channels on the screen. So blue is the weekly levels, green are the daily levels, and white are the RTH setting levels. And you can see that we are at the top of the cycle, right? 90, 55, 50 in the NQ on a 405-minute chart, and we're starting to pull back. That's exactly what the algos do when they get to this weekly level. Generally, they'll pull back. And so we're looking for a pullback to the 8066 right here. Let me put the price markers on this. I thought I had it. Or 806050. So there's a confluence right here on the mid band that you would expect to see that bounce. So coming into next week, if we were to measure that, 150 point drop to that mid band. So we've got about 150 points of a downward move starting next week off. And you can see that this mid band for the daily session has been holding price on this uptrend. So if that breaks, the next level that you see, if it breaks, I'm not saying it's going to break, I'm just saying if it breaks, then you're going to be looking for this second level, which is the lower end of the RTH and daily, to hold price and get a bounce there. And if that breaks, then the lowest of the low for this 14 period to save the uptrend, to keep it going, would be 83.3175. So we would want to see an absolute bounce here to save the overall uptrend. Now if I were to add some more days to my chart, don't put Bloodhound on your chart when you're doing this. There's way too many days to do this with Bloodhound. You just want to be able to come back in and check, and you can see that when it gets to the bottom of the daily RTH range in the past, like right here on December 4th, that's where the algos kick in. So what a wonderful place to go long, right? I think the big boys know about this 14 period, right? If you know what I mean. And then every time it gets to that upper weekly, it pulls back. Do you see what I'm talking about? This one just sort of powered through, but we definitely want to be careful up here. Um, and we're, anticipating a deeper pullback when we get to the weekly level. This one just sort of went straight through. There's been a lot of liquidity in the market. I mean, as you know, the Fed has been pumping in massive amounts of liquidity since about early October. If we go before the liquidity pump, you'll see what I was talking about. This is the normal overflow, normal order flow. So we got to the weekly and we rolled over, and this broke the bottom weekly. Uh-oh. We really got underneath our skis and underneath the level. And so this is where the big boys are all going nuts. Do we, buy it? Do we sell it? Is it over, you know, deeper pullback, or, we got overextended? So look for your Donchian channel. This is before the Fed started pumping in the liquidity in the market. And why do you think this happened? I'm just, fact checking you guys. We were going along fine, normal order flow. Do you see this going up into it? Staying with our 14 period algos, everything's working smoothly, everything looks good. And then, boom, it started tanking right here. And that's because the ECB started giving some press releases about what was going to be in that TLTRO3 for Mario Draghi's end of his reign over there at the ECB. Draghi keeps telling traders he's going to give you shock and awe. He actually did give us some shock and awe, because in September 12th, right here, where it started breaking again these lower levels, and these big downward pushes, um, he's opening up lending in Europe as close to Milton Friedman as you could get for anyone flying over Europe and just throwing money out of a helicopter to the banks. It's free money. There's no interest to repay on loans that the ECB will give the banks. The JP Morgan Chases, the Deutsche Bank, the Barclays, the whoever, the big boys, the big banks. And these are global banks that operate, in the United States and South America and England and Africa, all over the globe. So they can go to the ECB for zero interest and zero reserve requirements. So what happened when this was announced starting in August, you started getting the craziness in the market right here. This announcement caused this turmoil, tumultuous turmoil, because the press releases started coming out. And then when the program started right here and we got below that mid-band on the weekly mid-band, I guess our weekly bottom is down here, um, your Fed came in and started pumping liquidity in immediately. So this is where the liquidity injections started. And this is where that $500 billion, billion with a B, that's a B, billion, 500 billion has been pumped into the market since October 3rd. And so that's what's caused this. I mean, it's just pure liquidity. That's all this is. It's pure liquidity. So we're up at the top again. And our mid bands have been holding. Got to the top, mid bands holding, got to the top, mid band holds. So I'm looking for this bounce here to go back up. I mean, nothing should change as long as the Fed is pumping in the liquidity, and they have said that they will. They've come out and expressed in their minutes that they are going to adhere to a 1.75 to 2% in target range for the Fed funds rate. And so no matter what happens in the market, no matter if there's inflation, no matter what happens, they're going to manipulate the market to maintain that level. So we're in an uptrend. There's no doubt, because the Fed has promised they're going to do whatever it takes now. Instead of Draghi saying whatever it takes, now you're hearing the Fed saying whatever it takes to keep pumping in this liquidity. But they can't pump in, so that's 500 trillion in 3 months. Um, just say 3.5, 4 months, 500 billion. So that would be 1.5 trillion to 2 trillion a year in liquidity that they would have to pump in the market to get us through March of 21, when that TLTRO program is going to end. I don't think they can do that. I think they're going to have to lower their reserves, because right now no one's going to the Fed for funding. If you're wondering why they're having to pump money into the market, if this makes any sense to you, why go to the Fed and pay the Fed interest rates and reserve requirements? It's not so much the small interest rate, it's the reserve requirement. It's having to maintain a certain amount of their cash in the Fed on deposit to be able to receive those loans. It's called a reserve. So it's all of our Basel and our regulations that were instituted after the mortgage-backed security crisis of the 2008 that caused the financial meltdown. So all those regulations of our financial institutions are keeping banks now away from borrowing from the Fed, which has drained our reserves. And so that's why the Fed's having to pump the liquidity in. Um, and this is just I'm not an economist. I'm just seeing what's on my screen. I just know that they're pumping in $500 billion. I'm like asking myself why. So I did, my good litigation paralegal, I'm tasked to go find out why. So I go do my research, and I ran into this TLTRO, and immediately I'm like, well, hello. I mean, if you're a big bank, if you're a JP Morgan Chase, would you go borrow from the Fed, or would you go over to the ECB where they're throwing money at you for free and not even requiring you to keep any reserves? So that answers that question. Of course, they're not going to go to the Fed. They're going to go get their funding at the ECB. But you're saying, but Julie, that means that they have to loan that money into the European market. They can't use it in the United States. And I'm like, oh, no, 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 not so fast. Global bank. They don't have to loan that money immediately when they get it, placed in the market. They know it's not a quid pro quo. Give me $2 billion or 100 million or whatever, and I'll go put this project. It's not like they have to go explain what they're going to do with the money. They just get funding. They can hold the funding and go trade it in the derivatives market. That's not they can, that's what they do. They get their funding, they trade it in derivatives, and they trade it in spot forex, right? And then that's their monetization of that money. And then they turn around and lend it when they're ready, when they find a buyer. I mean, they may not even lend the whole amount that they've received. They have 3 years to pay it back with zero interest and zero reserve requirements. So, of course, trading is going to get better. It's only going to get better and better and better. And so don't fight it, right? just go with whatever floats your boat trading strategy. And right now, I'm sticking with this 14 default period because it works pretty darn good. You can see it right here on the screen. And just go with my short term targets. And that's why I have the short term target right here, the PT3 indicator, and I can look at a RTH level target or a daily target. So let's put some RTH targets up. So I'm going to load my RTH target, equities RTH, give me the dots so I can, see where I am. And so coming in here, you can see the up and down levels pretty clearly. We're in a strong uptrend, so anytime it gets below the white line and you get a tail that touches one of these lower ones, that's where you want to be a buyer. Take it back up. Anytime it gets below the white line, you want to be a buyer. So if we were to put some boxes up here and look to see what this looks like on a lower time frame, this is this was a really big, but look where this was a really big downtrend, but look exactly where the algo stopped on the 14 period Duncan. But this is where you want to be a buyer. So let's put this down on a 5-minute chart and go back in and look at that. Let this flip over to a 5-minute. I need to put some more days on here. Don't put, like I said, oh, that's plenty of days. Don't put Bloodhound on your chart when you're doing this because it's way too many days. So, let me go find those boxes. Here we go. Here's one. So this is where you want to be looking to get involved in the market for sure, because we know it's going to be in an uptrend. So how would you trade that, right? Well, this is your PT1. Let's see what this is. Oh, that's your 5-minute Donkian, sorry. PT1's up here. So we're below the PT3. You would either want to wait for it to get back above your PT1 to confirm it, or you can start taking trades when it breaks above at least your midband. I mean, I would not be trying to go long underneath that midband, but try to, think about it like an algo and take advantage of these breakouts and position yourself to get back long. There's nothing that's going to be changing. I'm going to put this back on 4 or 5 minutes. There's nothing that's going to be changing this scenario. The Fed has guaranteed us, it's in their minutes, it's in their statements. You can go look at their Kashkari statement. The Fed's going to do whatever it takes to pump liquidity into this market and keep that Federal Reserve's funds rate between 1.75 to 1 to 2. I think they're going to actually drop that to 150, give themselves a little bit more room, give them 2 points, 2 basis points from 150 to 2. And I think they're going to have to lower the reserve requirement to attract the lenders back over here. They're going to drop our interest rate and drop the reserve requirement. So mark my words, they're going to have to. I mean, they can't fight the ECB. So Mario Draghi, what he did was indeed shock and awe. He just upended the Federal Reserve banking system, precluding the banks need to put those. I mean, our whole banking system is built on reserves. I don't want to scare you guys, but if the banks are no longer borrowing, they're no longer maintaining their reserves here, it's over. So the Fed's going to definitely be lowering interest rates, and that's why you got Bernanke coming out last week saying that there's nothing wrong with zero interest rates, sort of pre-texting the event, getting the market ready for what's going to happen, I think. I think. But I'm not an economist. I'd be interested to hear, from some of what the economists, they probably think I'm a nutbag, but just my take. But right now, what I can take is that we've hit another cycle high. So I'm looking for that pullback to the mid band, and I'm taking the 150 points. Take the 150 points that you get at a time, 144 points, whatever it is, um, to the bounce box. So I'm looking for a bounce box around 80, 60, and 86, 65 on the bottom end. But yeah, I just, it's just going to keep going up until something changes, until they call uncle and say that we're not going to prop this market up anymore, which they can never, ever, ever do. They're like the Terminator, the Fed is. They'll just keep going, right? They'll just keep going, doing whatever it takes. That's their job. They have to do that. They have to keep this thing going, the engine running. So the only path that they're on is, a continual support of our financial system, which, in my mind, like I've said, would mean lower rates and lower reserve requirements, which would keep equities going higher. So don't get caught up in everybody else telling you that the market is so overextended. That is a joke. Let me show you what I mean by that. Let me put this on a weekly chart and show you that we have been overextended for quite a long time. Um, I mean, go back to 2010, right? 28. I mean, just because we've gotten a little bit of a hyper move here, it's nothing. I mean, we've been overextended since the very beginning of 2008 when the liquidity has come into the market. So just stay with the trade, is what I'm trying to tell you. Even though we're pretty much going straight up right now. But that's because the Fed has been injecting all that money in the system. I mean, like I said, 500 billion with a B since September. And that's when Mario Draghi changed the game and allowed banks to just get free money with no requirements at all, no interest, no reserve. So it'll be interesting. Um, be in the trade room. Y'all have a good one, and we'll take it our little 150 points at a time. Talk to you soon.